Good afternoon, everybody, and welcome to this month's edition of the Monthly Market Monitor. I'm Danny McIntyre. I'll be leading you through this magical journey. And we're going to have a little different twist today. Generally, we just walk through all the economic numbers and try to give you a little State of the Union address, so to speak. Today, we're going to take a little different path. We're going to look at the market consensus expectations that are built into the market right now. So we're going to look at the current market. We're going to look at what the market thinks we will be looking at in terms of a forward rate path. We'll look at some economic statistics that support that kind of explain the reason that the consensus is out there. We'll look at some data from the futures markets that also falls right in line, as well as some rate forecasts from the Fed themselves. We'll take a quick look at the yield curve. And because we're talking economics, we're always going to have to take the other side as well. And we're going to look at potential problems that could prevent that consensus from playing out. So we have an awful lot to cover in a very short period of time. So let's just jump right into it here. We start off with a graph of the Treasury curve. And here we have the green portion of this graph is the current Treasury curve. The yellow dotted line is where we were just last month, last time we had this webinar. And you can see not a great degree of change. We've seen the very short end of the market pick up in yield. And that's really just a function. We're getting closer to some additional rate hikes. And with that, it's going to pull the short end of the market higher. When we look at that 2, 3, 4, 5 year, even as far out as 7 years, we see that the market rates have actually dropped a little since last month. And then once we see the longer end, 10, 20, 30 years, we see that rates have been elevated when we look at this compared to a month ago. I always enjoy looking at the market and where we were a year ago, because you can just see the contrast right here. Again, in green, we have the current market. The yellow dotted line represents the market from January 10th of 22. And we see quite a difference. We still were in zero interest mode then. We can see 1 month rates were barely over zero. We climbed to about 0.25% at 6 months. We approached 0.5 at the 1 year area, stayed below 1 at 2. Once we hit 3 years, we climbed a little over 1% a year ago. You can see the vast difference we are now, where we're starting off over 4. But to me, the most interesting part is the actual shape of the curve. When we back up to a year, the curve was, more typically what we see in a yield curve. As we stretch out a maturity, we're getting paid more for taking that additional volatility risk. So we have a positively sloped yield curve. And what we have now is an inverted curve. We have our rates come up. They're peaking in that 6 month area right now. And then they start to go down from 6 months to a year to 2 years to 3 years to 4 years, 5, 7. It's all an inverted slope. So the longer we're going out, the less income we are getting, even though we're accepting that larger volatility. So curve right now is telling us that expect rates to go down. We'll get a little bit more into that as we go along here. Now, if we just want to pick one economic number to follow right now, it certainly would be the inflation number. I've actually got a couple of them that we're going to be looking at. First is the headline inflation, and that's CPI, the year-over-year growth in the consumer price index. And we've got the 5-year history here. You can see we're just chugging along at that 2% Fed target. And then in 2020, we ran into COVID and we saw a very sharp decline. And by the time we reached mid-year in 2020, we started to see inflation elevated. If you recall back then, there was a lot of talk about the supply chain and this being a one-off. The Fed remained in denial until actually early this year in terms of the fact that we may have a little problem on the inflation front. But we can see right now inflation has really kind of gotten away. We've seen it pull back, but we ran up here. Let me move this out of the way. We ran up to over 9% in June of this year, and the Fed's tightening has enabled inflation to start coming down, but we're still at 7.1 as of last report. We'll get a fresh number tomorrow. Expectations right now are calling for that to be up 6.5 year over year. So we're seeing it start to tone down. But again, Fed's target 2%, we're still an awful long ways away from that. And that has certainly been what's driving what's going on in the market these days. We can look at PPI, the producer price index, and really we put it up here, but we're seeing exactly the same thing. We saw the dip when COVID first broke out, followed by the steady increases. And now as the Fed has taken action in a very aggressive manner, they have been able to pull it back. But again, we're still hovering around the 8% on that. We'll get a fresh release on PPI in about a week and a half, 2 weeks. Now, what the Fed likes to look at when it comes to inflation, and really when they talk about their 2% target, generally they are referring to that personal consumption expenditures deflator on a year over year. And that's the good news there is it's a little more tame. That never got up to that 9, 10%, 11% that the other indexes reached. But it's still very elevated. It hit 7% in June. Where the other peaked, as we saw, at a little higher rate. And the latest report, it's down to about 5.5. Again, 5.5 is still an awful long way from 2, so the Fed still has some work to do. But as we've seen, they have certainly shown that they are very determined to bring inflation down and have it approach their 2% target. So let's look at the market consensus right now. Where does the market think we're going? And there's a lot of different things we can look at that can tell us this. But I can tell you that in general, what the market is expecting is that the Fed is going to continue to tighten through the middle of this year. General consensus right now is that the Fed will push the overnight rate up to 5.25, and that will happen the middle of 2023. Then the consensus goes on to think that after a very short pause, the Fed's going to pivot. And they will start cooling rates back down, 50, 75 basis points, depending on how you want to measure it. But certainly from like July to January of next year, they're looking at close to a 75 basis point pullback on the overnight rate. So that is pretty much what is priced into these markets right now. This consensus has been around for a while. We've seen it waver in terms of basis points. Where's the peak going to be? How much are they going to pull back? But the same general characteristics of the Fed to remain aggressive, fight inflation, beat inflation, and then start pulling rates back. That's effectively what we've been looking at from a consensus standpoint. Now, a couple things that really help support that, and I could have thrown a lot of charts up here, but I just tried to grab one for each example to save us some time. And here we're looking at home sales, and we can see in the middle of the charts here that the home sales really took a big dive in the beginning of the COVID epidemic. And then we started to see home sales just go crazy. These are existing home sales, and they just started going through the roof. Prices were going through the roof. Rents were rising. All this had an awful lot to do with the inflation rising. Inflation, especially when it comes to PPI, a very major component is the housing index. Almost 30%, I believe, of PPI is the cost of buying a house or renting. So that certainly has had some upward pressure. But what we can see more recently, since rates really began to rise, we started to see home sales decline in a big way. Certainly, most of you have seen that in your loan portfolios. It's much tougher to go out there and make mortgages these days in a higher rate scenario. There's just not that much volume going through. So with that being the case, it leads a lot of the speculation and, again, that consensus opinion that inflation is going to come down close to that 2% level to get the Fed comfortable enough to start lowering rates again. We can also look at the Fed funds futures market. Here we have what is lovingly referred to as WIRP, the World Interest Rate Probability. But in actuality, what we're looking at is just what level are Fed funds trading at for future delivery dates. So this gives us a very clear indication of not only what people are thinking in terms of where rates are going to go, these are where people are willing to buy and sell, come to an agreement of what the rate should be at a future date. What we have in the table that you're looking at is lined up with the Fed meetings. Our next Fed meeting is February 1st. And based on where Fed funds are trading, there is an anticipation that we're going to see another rate hike, but the Fed is going to be less aggressive now and probably raise 0.25%. The following meeting will be March 22nd. And essentially what's built into the futures market is another 25 basis point increase. So 50 basis points over the next two meetings. And then essentially an 1/8 point more going out to the middle of the year, where this has come now a little off of that 5% applied rate to a little bit lower, but the 490s. A very short pause. You see July from 493 to 487. And then the expectation that we're going to start to see that funds rate come down. 444 in December of this year, 423 next year. So again, just like the consensus, continued Fed aggression. Middle of the year, funds peak 5.25. At that point, there is a slight pause, and then the Fed starts pulling interest rates back down again. Now, the Fed themselves does everything they can to be as transparent as possible. And one of the nice things they do for us is they provide us their own projections of where rates are going to be. This is what's referred to as the DOTS curve. This is where each member of the FOMC, the Federal Open Market Committee, that is the voting members of Fed, those people who dictate policy, they show you where they think the overnight rates will end up at the end of each year. Now, these coincide with the actual Fed meetings. So the last one came out the middle of December, and we have to applaud them. They absolutely nailed where they would be at the end of the year. Fed funds right under 4.5%. We have a complete consensus that that's where they were going to be. So when it comes to projecting 2 weeks forward, A+ for the Fed. When we look at the end of 2023, again, the Fed kind of lines up with that consensus to some extent. They're looking for Fed funds to be a little over 5 at that point, then followed by a downward trend to where the following year they have it a little over 4. The end of 2025, a little over 3, and then continued downward movement as we go longer term. So for the most part, they agree, certainly from that peak level that they're kind of indicating that's where the consensus at the Fed would be. You can see from the dots, there certainly are people who are at the Fed who are expecting the rate to go higher, but the consensus remains a little over 5. An important difference, and we're probably going to bring this up several times, you notice this is for the end of December 23. The consensus opinion thinks by that point, Fed is already going to be pulling interest rates back. The Fed has never made any statements to that effect or really given us any reason to believe that that is the timetable they're looking at. But they are looking for funds to start going down as we get into 2024 and beyond. Now, we've also got one other very major force out there that's kind of fallen in line with this consensus. That is that rates will be going down in the future. And that is the actual yield curve. Right now, 1-year rates, these are approximate treasury rates. We did this yesterday. But the 1-year rate was about a 4.70. 2 years about 4.25. Then we dropped down to 4 for 3 years. 3.75 for 5 years, 3.65 for 7 years. So when we're looking at the 1-year portion of the curve trading at 4.70 and the 2-year at 4.25, essentially what the yield curve is telling us that it expects that in 1 year, the 1-year rate is going to be approximately a 3.80. Now, how do we come up with that? Well, you just look at those two returns. If someone is willing to accept a 4.25 for 2 years, knowing that they can get a 4.70 for 1 year, then what we can do is go in and say, what's the second year going to look like? If we can get a 4.70 for a year, when that 1 year is done and we're going to reinvest for another year, what rate would equate to be the equivalent of investing for 2 years at 4.25? And it's a pretty simple average. If we have 4.70 the first year, then a 3.80 the second, we end up with a 4.25 average rate over that 2-year period of return. And because people are willing to accept a 4.25 for a 2-year investment with that 4.70 out there for a year, it is telling us that they also expect that rates are going to be in a downward path. So that is another very strong indication that the participants out there, the market consensus is going to be looking for rates to start coming back down at some point here in the future. But it's really that portion of the consensus that we really want to take a look at, because it certainly is an extremely important ingredient. Is the Fed going to pivot this year, or are they not going to pivot? That certainly is the most important question that you can ask at this point. There's a great degree of things that line up that point to that 5.25 by the middle of the year. Where it goes from there is where you're going to start to see some differences in opinion. But again, the consensus looks for the pivot and for the Fed to pull the rates back down. Now, what's it going to take for the Fed to do that? The first part of that equation is critical. They have to have won their fight against inflation. They have to have inflation either at 2% or falling down to where they're very comfortable that it's going to be at 2%, their target rate, where they can basically declare victory. It's going to have to be sufficient enough for them also to be comfortable with lowering rates and possibly reigniting inflation, so that they're going to be a little hesitant. So the inflation battle is certainly going to be the most important ingredient as to whether the Fed's going to pivot or not. So we'll just have to keep our eyes on that front. A couple things that the Fed has been mentioning recently has been their concern about the employment number. The employment data continues to show very strong employment. We can sit there and see that this sharp spike in early 2020, we know what caused that. But since we have seen the unemployment rate fall to where we're sitting around 3.5% right now, very, very strong numbers, and we really haven't seen any upticks to that. When you combine that with the strong wage growth that's embedded in the employment data, it's been running around a 5% rate year over year, I believe. That has been certainly some talking points the Fed has put out there to express their concern about how difficult it may be to get inflation down to their 2% target, and that they are certainly watching that number, and they're going to have to see a higher number, I think, before they get comfortable pulling rates back down. The other thing that the Fed will mention frequently in their press releases and in their speeches is the fact that the consumer is just continuing to spend money. We can see, again, a 5-year chart of personal consumption, very steady until we hit the early stages of COVID, where it basically stopped. And then as the government started handing out checks and the Fed started flooding us with liquidity, we saw very sharp spikes in spending. It calmed back down a little above where it was averaging, but now we're sitting right at the average, but nowhere lower than that. So even with this massive liquidity drain that the Fed's been going through, with the inflation that's out in the system, consumers are continuing to go out there and spend. And again, that's another concern that the Fed has in terms of their ability to squash inflation. And it certainly is going to be part of the story as to, are they going to be in position to be able to start lowering rates once we pass the middle of the year, if they have been successful fighting inflation. Again, here, I just pulled up the Fed dot curve again, the dot graph. And I'm just going to point out once again, end of 2023, the Fed still has rates over 5%. In fact, in the minutes from the last meeting that were released a week ago, there was a lot of talk about the Fed's concern that the market was pricing in this pivot. The market was expecting them to pull back, and in that conversation, they made it very clear they don't see that happening. They don't see where they expect that they're going to be pulling rates back over that timetable. So that's something very interesting. I mean, is the consensus right? Is the Fed right? We'll see what ends up happening. History tells us that typically neither one of them are right. So someone's got to be right in this case. So we'll see which falls into that category. Now, as we talk about this pivot, it's very important to come back and take another look at the yield curve. And what I like to do is just try to think about where we're going to be 6 months from now. And let's say that the consensus is right on target, that Fed funds are now in that 5.25 area. And in the middle of the screen here, what I have is where our current yield curve is. 4.70 for a year, 4.25 for 2, 4% for 3, then we dip below 4 for 5 years and out. How comfortable are we going to be at that point to accept those kind of yields with funds sitting at 5 to 5.25? And I think the basic answer is if the consensus remains that the Fed is getting ready to start shifting back down and start lowering rates, it's possible that we're able to stay there. It's possible that the curve can maintain its current shape and maintain its current levels. The problem that I see as a possibility is what happens if that consensus shifts? What happens if the market now starts thinking that either the Fed's going to have to go higher, they're going to have to be more aggressive to beat inflation, so we start going to 5.25, 5.5 or beyond? Or what happens if the consensus shifts to the 5.25 work, but we're going to have to sit here for a while? The Fed's not going to shift gears and take any chance of reigniting inflation. So this 5.25 is going to be around for a lot longer. Where certainly you can figure if you're a one-year investor at a 4.70 and you don't see any near time schedule for rates to start coming down, it's very unlikely that you're going to be satisfied with the 4.70 going out to a year. You're probably going to want that 5% at least. And the same would be true for the 2, 3, 5 years. It's really going to be dependent on what that timetable is going to be and how aggressive they would envision the Fed being, pulling rates back down. What we have in the bottom table here is what happens to $1 million investment that started off as a 1 year, 2 year, 3 year, et cetera. And then we fast forward 6 months and we say, let's take it. This really isn't the worst case, but let's take a relatively bad case and say, at that point, funds are 5, 5.25, and nobody can really see at what point the Fed's going to start bringing rates back down. Inflation is getting close to 2. It's not quite there yet. The Fed's certainly making progress. It's heading in the right direction. But how is the economy holding up? Is employment still strong? Are consumers still spending money? Is there anything that's really motivating the pulling rates back? If the answers to those are no, that we just can't see at what point the Fed's going to start relaxing policy and start making that pivot that's currently built into the curve and built into the consensus opinion. What if everybody says, okay, I want 5%? This is what happens to your market values. If you had a one-year piece of paper, 6 months have gone by, so you only have 6 months left, but you've gone from a 4.70, now that's going to be priced at 5. You're going to lose about $1,500 in value for every million that you have outstanding. If you started off as a 2-year investor and you went back to a 5%, then you are looking at the market value declining $10,700 per million. If you started off as a 3-year, 23,200 per million would be what it would take to get you up to a 5% yield. And you can see as we stretch out, two things are happening. One, we got just the natural volatility that's associated with the longer durations. But we also have a much bigger mountain decline. We're going from 3 3/4 up to 5% now. So it will take almost a $50,000 drop in market value to get us there if we started off as a 5-year, almost 75,000 if we started in the 7-year area. And now we're talking 6 digits per million if we started off in the 10 years. So have to really be aware of that being a possibility. I'm not by any stretch saying this is probability, but I just think when you start walking through scenarios and say, from a common sense standpoint, what possible problems could we run into? This could certainly be one of them. Again, it's geared towards that Fed pivot. How aggressive will the Fed be? How quickly will they make it happen? How will the consensus shift? And believe me, the yield curve is going to be affected if that consensus opinion starts to shift, where they expect the rate to go higher or to sit there for a longer period of time. So certainly something to be aware of. And as you can see, especially for investments that right now are in that 5-7 year period or beyond, there's an awful lot at stake if this scenario would play out. So what's this bring us to? Well, familiar lessons that somehow always find their way to the end of all our webinars, it seems. Be aware of red flags. When we're looking at market consensus expectations, it's certainly the majority opinion. That's what makes it a consensus. But what history tells us is that, it's not fact. We really don't know what's going to happen. It's just what the market's thinking at the time. It's how the market is pricing at this point. So it's certainly very important to be aware of it. But it's also equally important to be aware that it's not necessarily going to be the path that rates take. Perfectly fine to manage your balance sheet based on your expectations of what path we're going to go down, but always critical to understand what happens if rates take a different path. What happens if they go the direction you thought, but then go beyond that. They go a little further or last a little bit longer. Or what happens if something else pops up, if we have another COVID event, or something that could really shift the whole outlook and change things in a heartbeat. Rates tend to be volatile and they tend to move in different directions. So again, while we can manage to what our expectations are, we want to make sure the portfolio, and more importantly, we want to make sure the balance sheet is still in a good position if rates take a different path, that we're not going to bet the farm making interest rate bets, that we're going to put ourselves in the best position we can for the rate path that we expect, but we're going to be perfectly aware of what dangers may be out there in terms of the balance sheet and be ready to make any adjustments very quickly if they need as those expectations start to shift. I can answer any questions you might have. I went through this. Do I leave any time? I'll have like 2 minutes for questions. If anybody has any, I'd be happy to answer them. If nothing comes to the top of your head right now, you can drop me an email. I think my mother came up with this email address, daniel.mcintyre@corpcu.com. There's my phone number up on the screen if you'd like to talk to me. For those of you that have been listening for the past hour or half hour, however long we've been talking, and have decided that's about as much of Danny as I can take and would like just to talk to the investment department, you can reach us at investments@corpcu.com. I would not be offended. I readily understand. I don't like listening to myself either. So if we don't have any questions, I will thank you for joining us. I appreciate your time. Appreciate your business. We're here to help you. Give us a call. Thanks a lot.